In terms of monetary policy outlook from the US and interest rates, now the Fed has made it interesting. Jerome Powell has led his various Fed presidents to hint and suggest very strongly that they will be very patient in hiking interest rates. And of course, market like what they hear. Now, we think that the important thing here is that the Fed will be very data dependent. On that note, US growth is still very strong, although it's moderating from the highs, and of course the job market is at 50-year record strength with strong wage growth. So in terms of data dependency, our view from UOB is that the Fed, if they do pause for now, does not mean that they will stop hiking rates or even cut rates. We still think on balance, the relatively strong data from the US will still allow them to hike twice this year. Once somewhere towards the end of June and once towards the end of the year around December. And on that note, in terms of interest rates, we think US 3-month LIBOR should still trade above 3%, a bit on a very slow pace, and of course that will lead the Singapore SIBOR and SOR rate to trade above 2% as well, somewhere in the second half of the year. With the FX space, now things will get even more volatile and interesting for 2019. In the currency markets, currency traders are already pricing in the end of the Fed rate hikes when Fed fund rates taper off at the inflection point nearer to 3% by the end of the year. So you notice that we started the year with a fair bit of US dollar weakness and Asian currency strength. But for now, we believe that is premature. The renminbi will still be pressured and stressed by ongoing weakness in macroeconomic growth out of China. If Chinese authorities do ease monetary policy further, do pump more fiscal stimulus, that will still push the renminbi lower as the year progresses. We like, however, the euro-dollar. We believe that the European Central Bank should start hiking rates towards the end of the year, about 4 years after the Fed starts its rate tightening process. This is positive for the euro over the longer run. So on balance, for this year, we like the euro-dollar and we are still cautious about renminbi in the currency space. So back home to Singapore, what does that mean? Now, we all know that the MAS has tightened monetary policy twice last year in April and October. And as we head into this year, Singapore's growth prospects seems to be moderating quite a fair bit. Now, if we do get more weakness in terms of growth, more weakness in electronics production, and of course exports in the first quarter of the year, all we need is for the MAS to sound a little bit more friendly to market concerns, and then perhaps the Singapore dollar may weaken anew. After all, Singapore dollar has been kept on a very strong note against its Asian currency peers, like the renminbi and the Malaysian ringgit. So on balance, we believe as the year progresses, dollar Sing should rise back up towards 140 rather than fall on a sustained basis below 135. As a summary, investors again should be ready for more volatility. This will be the buzzword for 2019. In the currency space, we believe that we like the euro, but we're cautious in the renminbi. And of course, in interest rates, do not price out further Fed rate hikes. We still see 2 more hikes as the year progresses on a gradual basis. So rates should still gradually rise higher. And back in Singapore, a lot will depend on how MAS does the monetary policy when they next meet back in April.